losses are far more impactful than wins. Warren Buffett, the greatest investor of our time, famous quote for investing is, rule number 1, don't lose money. And rule number 2, don't forget rule number 1. And in this video, I'm going to dive into why that holds so much validity, and there is a lot more to unpack in that quote, deeper than what it seems. Now, if you don't know who I am, my name is Matthew Jimenez. I come from a finance background with 8 years into trading and investing, and I also have a couple other businesses. I've been blessed to work with some of the greatest people in the finance industry, from Robert Kiyosaki to Peter Schiff, Mark Moss, Ken McElroy, George Gammon, Joseph Brown, and the list goes on. Being around all these finance gurus, I've been able to act like a sponge and absorb a ton of do's and don'ts when it comes to investing. So I decided I'm going to start making my own content revolved around finance. I think I can bring a new perspective to the world of finance. For a lot of people, unfortunately, do not have the financial literacy to make appropriate investing decisions. Now, by no means, this is not investing advice whatsoever. This is just solely my experience and what I am doing and what I have analyzed over the years of being in finance. Without further ado, let's get straight to it. So before I unpack Warren Buffett's quote, first we need to understand a little bit about risk. Oftentimes we hear a lot of people online talking, well, what is your risk tolerance? Are you okay with losing $200, $1,000, $10,000? And while there is many caveats to this subject, I'm going to tell you exactly why that does not make any sense. Risk should be based off of your account size, not your willingness to lose X amount. Here's what I mean. Let's say your risk tolerance is losing $200, but your account size is only $400. That is a 50% haircut of your initial capital. So when we look at risk, we need to address it in percentages, not dollar amounts. That is the biggest red flag when it comes to the investing ecosystem and environment of entrepreneurs talking about investing. They always look at dollar amounts rather than percentages. And that is the biggest mistake that I found in my journey. Based off professional investing parameters, 2% is typically the safe zone to be risking per trade. Let's say you have a $10,000 account, you can only be risking $200 per trade on any given trade. In order to calculate 2% or $200, you need to understand how risk is measured and what increments they're measured in. In this video, I'm going to stick to the foreign exchange market, so we are going to go based off of a metric system called PIPS, percentage in price. And the way PIPS are measured are based off of your position sizing, also known as your lot size. So if you go to the far right of the numbers, this is valued at 10 cents all the way up to 90 cents. Now, if you move over just one to the left, you now have a mini lot, which is valued at $1 to $9 per movement. And then you move to the far left, which is the standard lot. This is where you see most of the Instagram gurus looking like they're making a lot of money. The standard lot is valued at $10 upwards to whatever the account can hold based off of the broker's leverage metrics. So now that you understand basic terminology and the valuation of PIPS, you will be able to calculate what position and lot size is best for you depending on how wide your stop losses are, considering you are using stop losses. So quick example, let's say you have a $10,000 account and you want to trade on a standard lot and your stop loss is 20 pips. Now remember, a standard lot is $10 per pip for every movement that the pair will make. So having a stop loss of 20 pips and you have a $10,000 account, this means that you cannot enter this account because it is inappropriate in terms of professional risk parameters. Because every single trade that you execute will have a spread because the broker needs to get paid. So they will oftentimes put a spread between the actual asking price and what they are offering. That difference between actual price and what they're offering is called the spread. Normally, every broker has their own spread into place, and these numbers are always varying depending on the time and what pair you are trading. But let's say you have a trade that you want to take and your account's $10,000 like we said, but the entry to that trade is about 5 pips. Now you are spending $50 already just to enter the trade just off commission. Now you need to either adjust your stops to make sure that you stay within the parameters of the 2% appropriate risk. Okay, now that we've gone over really basic measurements and how to position yourself based off of spread and stop losses, let's get straight into the purpose of this video. And if you have any confirmation biases, please just exit the video now, because you will not be a fan of me after hearing what I have to say. Day trading is a zero-sum game. So let's apply Warren Buffett's quote. Rule number 1, don't lose money. And rule number 2, don't forget rule number 1. And let's break this apart as to why this matters so much. Because let's say you're a good trader and you win a lot of trades. Either way, that really does not matter. Losses will always outpace your wins. Let's say you want to trade a little bit more aggressive than 2% because you want to make some actual voila. But let's put the risk parameter at 20% of your $10,000 account. That puts you at $2,000 of risk for any given trade. Let's say your first trade unfortunately was a loss, which is very likely when it comes to trading because it is a 50-50 probability. You either hit your stop loss or you hit your take profit. There's no in between. And yes, I get it. You could technically break even depending on if you are in profit and you move stops, but let's stick to this for simplicity purposes. So now your account is down to $8,000 after taking that 20% loss. In your mind, you're saying, okay, I need another 20% on this next trade in profit to make back my loss and take me back to $10,000. Unfortunately, that is not true. If you have a 20% gain from an $8,000 account, that puts you at $9,600. Why? Because what's 20% of 8,000? That is 1,600. Because after a losing trade, you are always forced to risk more on the next trade. So if you want to get your account back to 10,000, which was your initial capital, you are obligated to risk more if you want to get there on the next trade. This is why losses are far more impactful than wins, because they always will set you back to take more risks. Secondly, the notion that you can quit your day job and just be a full-time day trader is an extremely bitter pill to swallow, because it probably won't happen. And no, I'm not here to crush your dreams. Anything is possible, dream big, but always be rational and understand that if you do want to win and be able to quit your 9-to-5 or make an immense amount of money, just understand one thing. Cash flow is king. With that being said, let me get into my next point here. Remember earlier, based off the parameters of appropriate risk of 2%, let's say that you still have this $10,000 account and you want to be a full-time day trader. And let's say you're sticking to the appropriate risk of 2%, or rather, scratch that. You're trying to survive. Let's go ahead and try to only risk 10%, which is $1,000 per trade. And let's say you're profitable of 10% that month. 10% of 10,000 is only $1,000. Based off of America's standard of living, you need a minimum of $4,000 in monthly recurring revenue to afford a standard way of living. Now you can see if you were to quit your day job, you would need to at least make 50% profit per month on your $10,000 account, which is $5,000 every single month. And the odds of making 50% per month in profit is extremely unlikely. So you can see how day trading can be an extremely high risk environment, inducing tons of stress into your day-to-day activities. What I've done over the years is I've moved from trying to be a day trader to just passively investing and worrying mainly on cash flow, which is something I could directly control with modifications in my businesses and services that I provide. Doing so has allowed me the freedom to passively invest without the strain of thinking I need to make 50% this month in profit just to pay my bills. The second thing that I focus on now is actually utilizing something that I was super against when I first started day trading, because Remember, I wanted the lavish lifestyle of working from a hot tub in Hawaii on my laptop, sipping a mimosa, like everyone in the Forex industry. The moment I got rid of that and came to realization, I then pivoted to using software to actually trade for me. And surprisingly enough, as much as I was against this when I first started trading, I now fully rely on it and do not have the pressure nor the stress of trying to sit and watch 20 pairs at any given moment for the exact setup on all 20 pairs, because God forbid I miss a single trade that I need for this month to pay my bills. With the utilization of AI and the sophisticated tech that's coming out these days, it has made an extreme impact on my life. And this is something I like to call smart risk. I often use this term a lot, and you'll hear me say it from time to time. And the moment I dropped my biases and realized I can't efficiently manually trade every single day and be omnipresent across all charts, and I started leaning more and more on software to trade for me, I realized the power of this tool if you can find the correct one. If you're interested in the one that I use, the description is down below. And like always, if you enjoyed this video and you found even 1% of value, please go ahead, leave a like, comment, and or subscribe. It supports us and it supports the channel, and it makes me want to do this even more than I already do.